Here's our Forex blog for June 25th, 2013, and these are our currency indexes, which let you see what all the dollar pairs are doing, euro pairs, Swiss, Australian, and so forth. And like you can probably imagine, the secret to using this is to basically identify a currency's trend, and when it's trending down, you want to sell it versus whatever the stronger one is. You can see the dollar's trending down until about 5. This one, the Canadian, pretty much is going up after that, especially from around 3 to 5 it's trending up. This one's going up from 4 to 5, the New Zealand. So if you brought up the New Zealand the New Zealand dollar from 4 to 5, you're going to see this thing explode up. Actually, I think 3 to 5, and you can see that's exactly what happens. Now, most of the time, these strong trends tend to continue, and so you can get in on board the first trade, wait for a pullback or a sideways move, get in again, and so forth. But you can also use this tool to anticipate future price direction. For instance, here is the most anticipatory trades that are on the chart. One, you have like a trend line that finally gets broken here. Also, the previous day's low gets hit and finds support. When this area gets broken, like in the Swiss, it tends to be a big sign that the trend is going to continue. But these are very key areas of support resistance. Notice resistance up here, support down here. This one acted as resistance all morning, and then there was a false breakout here. Anytime you get a false breakout, when it comes back into the range, it's very likely to go the other way. And when you see a bounce off of support where it goes up and it comes back down and doesn't even double bottom there, another very high probability trade would be to buy this breakout here. It wasn't, market leaders weren't able to take the dollar down weaker today than it was the previous day. And then when there's a nice little rally, trend line break right here, very high probability. You also can draw Fibonacci areas on your charts, and usually at the fib target level, it's also very likely to reverse. So this is a place where you could sell the dollar. You'd want to find a currency that was likely to go up at that time, let's say 10 o'clock. Here's the pound, which is already kind of drifting up slightly. It's right near the previous day's high. 10 o'clock would be a great time to look for pound dollar buys, because the pound's very likely to go up, the dollar is very likely to reverse, and you can see here that as you are looking at this chart around 10 o'clock, you might have bought this one right here with a small loss. It comes down to our lower containment band, you get in again here, you can see it went up about 25 pips. And of course, after the next pullback, it also went up. And that's how you use our software for anticipating trend direction. Also, when you see a strong trend, usually the first or second pullback is very high probability. So the Australian, these are key areas of support. Once it breaks it, it becomes, once resistance gets broken, it becomes support. You might also look for this buy here and here. Obviously, this first pullback here was one of the better trades. This one here probably failed, or you had a small win, and this last one went out for a couple hours. Same thing with the Swiss. Breaks down, you know, you get short right here, short right here, short right here, short right here. As long as it stays underneath the previous day's low, it's a pretty high probability trade. This one here is kind of going sideways, breaks out, you buy the first pullback, and guess what? The next 2 hours it goes up. So let's take a look at that one. That's one of the better ones, 4 to 6, just exploding up. Which one is weak at that time? Well, the euro is. The pound is trending down, and you can see once the currency is kind of going down, you get a little pullback. It's very high probability. So let's take a look at the pound CAD sell a little bit after 4. This is one of those trades where you like to make 30 to 50 pips. From a little bit after 4, this is a very strong downtrend. You can see on the chart right here, it hit the first lower containment band. A lot of times at and below the 2.0 white band is where the market reverses. You have a nice little pullback right here. This is where your stop would be, and typically you're going to draw your fibs off of this, and your fib target's down there where you're going to take your profit. So let's draw the fibs on here just so you can see where your fib target is and where your profit is. So basically your stop would be right above the high. This is what your risk is. This is what you're anticipating as your profit. And it went a few pips beyond that, but you can see the risk versus the reward makes this worth taking a trade. It's also not at or below our lower white band. Typically at or below the lower white band, price reverses. Also, using a perfect oscillator, when price, especially when it's outside the bands, hits the -80 level, you tend to get either a sideways stall or a reverse. So if you look at some of these, you know, this one had a little bit of a reversal. This one here stalled for 40 minutes, and this one here had an explosive bounce. When it hit the upper level right here, guess what? Price pulled back 20 pips. Hit the upper level right here, price pulled back. So when you use all, and look right here, lower perfect oscillator, bounce, right here. A little bit of a bounce right here, not much of a bounce, but 15, 18 pips. So when you use our tools in combination, the currency index and our statistical tools that we oftentimes put on them, FX trend intensity and many other ones, they will show you what each currency is doing as a chart. You can see wedge patterns, flag patterns, Fibonacci reversal areas, and so forth. And once you identify a currency it's likely to go, you just bring up that chart and wait for a little pullback, or if it kind of goes sideways in a rectangle pattern, when it breaks down, you get in. You know where your fib target is, and it always helps when the perfect oscillator is at an extreme. Anytime a profit target's hit and the market's gone down statistically way too much, unless you're an idiot or extremely greedy or both, you're going to get out of your trade here and make, in this case, 10, 20, 30 pips while risking less than 10, or maybe 10. That's a 3 times bigger win than what your risk is. So let's show one more example. Here the CAD, you know, was going up. Well, we'll use another one other than the CAD. Let's look at the yen here. Big explosive move up last night, pulls back. You could look to buy the hourly moving average here. When it comes up and it can't break the previous swing level, very high probability place to look for reversals. So from 5 to maybe 6:30, which one's the strongest or likely to reverse? Well, this one's going down at that time. This one's kind of going sideways, so you could certainly trade that. The euro's underneath the hourly. The dollar's underneath the hourly. So the yen's likely to reverse. And from 5 to 6, really only the CAD and the Australian, you know, are doing anything either going sideways or up. So CAD yen from 5 to 6 or so, we're looking to buy. Let me just go and verify that this is the right one. Especially after 5, we're looking for sells, because the yen's strong, it's likely to pull back. This one's kind of grinding its way up, and so is this one. So this is probably not the best example, but you can see how to use it when one currency is just kind of going sideways. We're looking to buy dips, and one way you can do that is when the perfect oscillator hits the lower Bollinger Band around it, or the -80 level. So this one you might just get in right here. It's underneath the hourly, so you get out here with a small profit, 10 pips. Again, another buy. You know, you can see that one went up about 30 pips, and it was really from, I think, 5 to 6 or 6:30. You have another pullback right here to the hourly. This is at an extreme, short-term extreme. The -80 and +80 levels are far superior. As you can see, there was only one of them per day, and the market pulled back, you know, 12, 13 pips. That's it. The rest of the time it came real close to those levels. Again, underneath the hourly, it's more likely to go down. Above it, more likely to go up. Let's take a look at the second one on here, which, unlike the CAD, is the Australian yen. Remember, at that time we're expecting the yen to reverse because it double tops. So we're going to be looking for buys, you know, at these lower bands in the -80 level. Kind of this trade right here. This thing kind of starts going up. You move your stop up, you lose 5, 6 pips on that. You get in the second one, you can see it comes back to the hourly. Good place to get out. So you lose a little bit. You're never going to catch every pip. Let's just say that you have a small loss, a 2.5 to 3 times bigger win, and really that's just the key to trading. Don't worry if any individual trade works or doesn't work. Just focus on being in the ones that are most likely to reverse. Watch the perfect oscillator. When you see a +80 level or a -80 level, you might want to look to get out, because it's usually reverses, just like this. This one kind of reversed a little, came down a little bit and reversed. Notice this made a lower low, and this, you know, it's right at the lower Bollinger Band levels of these, which also are excellent places to time your buys and your sells. And again, if it's a few little points away from the plus or minus 80 level, look at this, pulls back 10, 20, 30 pips. The currency's been going up all day, and it's just kind of slowly grinding up, and this hits an extreme, mainly because this is kind of a dead time of the day. This is called the perfect oscillator for a reason. It is an extremely effective tool. Occasionally it's wrong, like right here. Markets was so weak at that time. This is relatively dead time of the day, so it can show an extreme with much less movement. But again, it comes down to the lower band. This is also at minus 80. Typically, when I see these extremes, I wait for it to go above the previous bar's high before getting in. You don't just buy. If you had done that, basically it would be waiting for a breakout, waiting for a breakout, waiting for a breakout. Never went above any of those previous bars high. You can avoid a lot of bad trades that way. So that's it for today's blog.